All right, jump right in. Welcome back to the deep dive. Today, we're tearing into a stack of source material you provided, all centered around one of the biggest names in cybersecurity right now, CrowdStrike.
That's right. A lot to unpack here.
We've got their recent fiscal Q1 2026 earnings report, the deep dive into how the market reacted, and a look at their strategic position. So our mission, based strictly on the facts in these sources you shared, is to pull out the key takeaways, those aha moments giving you a clear picture, especially from an investor's viewpoint.
And what's really fascinating looking through this material is how the market digests these, sometimes conflicting signals. You've got strong metrics, but then maybe cautious guidance.
Exactly. Understanding that interplay just based on the sources is key.
It really is, seeing the full picture.
Okay, so let's start by unpacking the raw numbers. Straight from the Q1 earnings overview, which ended April 30th. What were the headline figures that jumped out?
Well, kicking it off with the top line, revenue hit $1.1 billion. The sources noted this was a solid 20% increase compared to last year.
Okay, 20% growth.
And importantly, it met the consensus expectations analysts had. Right on the money there.
Okay, revenue in line. What about the bottom line? Profitability.
Right, moving down. Adjusted EPS, earnings per share, came in at 73 cents. Now, the sources highlighted this actually beat analyst estimates, which were around 66 cents.
So a beat on EPS. Good sign.
Yes, but, and the sources did point this out, that 73 cents was slightly down from the $1.79 in the same quarter last year.
Okay. So better than expected this quarter, but a dip year over year. Got it. What else stood out financially?
A big positive highlighted was free cash flow, FCF, the actual cash generated. It hit a record $279 million in Q1.
A record, wow.
Yeah, and the sources emphasize this represents about 25% of their revenue for the quarter. That's a strong conversion rate. Investors definitely watch that closely. It signals real financial health.
Right, that cash generation is crucial. And their core growth metric, annual recurring revenue, or ARR.
Yes, ARR, absolutely central for CrowdStrike. The sources reported ARR grew 22% year over year, reaching $4.44 billion.
Solid growth there, too.
And they also specified the new net ARR added just in Q1. That was $194 million. So good momentum adding new subscription value.
So it sounds like Q1 fundamentally was pretty robust. Revenue met, EPS beat, record FCF, strong ARR. Where did the sources say this performance came from? Key drivers.
They did break that down. The Falcon platform, their core offering, is still the engine. And within that, Falcon Flex was specifically called out, big contributor.
Falcon Flex, good.
Its ARR reached $3.2 billion across over 820 accounts. And what's really notable, according to the sources, is the sequential growth in new ARR for Falcon Flex, quarter over quarter.
Yeah.
That surged 31% to $774 million. That sequential jump suggests really strong recent traction.
Okay, Falcon Flex clearly pulling a lot of weight. What about other parts of the platform, other modules?
Yeah, the material also pointed to strong adoption across their broader suite. They mentioned uptake in next-gen SIEM, security information management.
Right.
As well as cloud security, identity protection, and that AI tool, Charlotte, for triage. It suggests their strategy of selling more into existing customers is working, landing and expanding.
So strong Q1. Driven by core platform expansion, especially Falcon Flex. But then, the sources mentioned a significant headwind, that July 2024 outage, right? What was the impact there?
This is where things get a bit more complex. The sources detailed the tangible costs. They noted it caused about a $29 million hit to free cash flow in this past Q1.
Ouch, okay. Direct hit to cash flow.
Likely from customer credits, response costs, things like that. And the material also indicates an expected future revenue hit, estimated around $10–15 million for this current fiscal year.
Due to outage-related factors.
Exactly. Maybe concessions, maybe some delayed deals. It's a lingering effect.
That makes sense. So how did this outage and its costs factor into the guidance they gave for the next quarter, Q2?
This is really a key point the sources focused on, the guidance for Q2 revenue. They set it between $1.145 billion and $1.152 billion.
Okay.
Now, compared to analyst expectations before the report, the sources noted this came in just slightly below the consensus, which was around $1.16 billion.
So a slight miss on the revenue guide versus expectations. That's often a trigger point for the market. What about the Q2 profit guidance?
Well, on the adjusted EPS side for Q2, the guidance is $0.82 to $0.84. And the sources highlighted this was actually slightly above analyst estimates.
Okay, so that's interesting. Revenue guidance a bit light, but profit guidance slightly ahead. Kind of a mixed signal.
Definitely a contrast.
Did the sources mention anything signaling management's confidence, especially given the cautious revenue outlook and the outage?
They did, yeah. The material specifically pointed to the company authorizing a new $1 billion share repurchase program.
The buyback.
Right. And this was framed in the sources as a clear signal from management, basically saying, we believe in the long-term value despite the near-term caution reflected in that revenue guidance.
Okay, so let's recap the picture from the sources. Strong Q1 results overall, but this tangible outage cost hitting cash and expected future revenue impact, and then Q2 guidance that was slightly below on revenue, slightly above on profit, plus a confidence signal with the buyback. How did the market react to all that?
The reaction described was pretty immediate and quite sharp. After the earnings came out, after hours on June 3rd, the stock took a significant hit, fell about 6–7%.
Wow, okay.
Dropping from around $488 down to the $457, $461 range. And the sources also noted it fell further, another 5–6% in the main trading session the next day.
That's a pretty big drop for what seemed like decent Q1 numbers. What did the sources say drove that sell-off?
They were quite clear. Primarily two things. First, that Q2 revenue guidance miss compared to consensus.
Or the forward look?
And second, just ongoing investor concerns, maybe uncertainty about the full impact and the recovery from that July outage. Even with a good Q1, the market focused on what's next in that recent issue.
Did the wider market context play a role? Was tech broadly selling off?
Actually, no. The sources mentioned the broader tech market was pretty resilient then. The NASDAQ, the S&P, they were advancing.
Ah, so CrowdStrike's news stood out.
Exactly. Their cautious guidance and the outage issue contrasted with that broader strength. According to the sources, this likely amplified the negative reaction specifically towards CrowdStrike.
So the market takeaway, based on these sources, seems to be sensitivity to growth misses, especially for high flyers.
Precisely. The sell-off, as interpreted by the sources, reflects that sensitivity, particularly in high-valuation tech stocks. Any hint of deceleration matters, and the outage just added a layer of execution risk on top.
Makes sense. Okay, let's shift gears a bit. Beyond the quarter, the sources also looked at CrowdStrike's strategic position, their place in the cybersecurity market. Where do they stand?
The material positions them as a clear leader, number 1 or number 2 in endpoint protection. Big competitors mentioned are Microsoft, Sentinel, Palo Alto Networks.
Heavy hitters.
Yeah, and their leadership is validated externally, too. Sources cite Gartner's Magic Quadrant, consistently placing them as a leader there.
And their customer base, how big is it?
Substantial. Over 29,000 customers globally, including 63% of the Fortune 100, plus many U.S. federal agencies.
Yeah.
Strong enterprise presence.
So with that competition, what's their edge, their moat, as the source put it? What makes them sticky?
Several things outlined in the sources. First, the Falcon platform itself. Cloud-native, lightweight agent, central intelligence across endpoints, cloud, identity, data.
The core tech.
Right. Second, and this is critical, the threat graph. Process trillions of events weekly. This enables real-time detection and creates powerful data network effects. The more data it sees, the smarter it gets for everyone. Hard to replicate.
That network effect is huge in security.
Definitely. Then there's brand strength, their reputation, expertise. The sources mentioned the DNC hack investigation back in 2016 as something that really boosted their profile.
Ah, yes, I remember that.
And finally, switching costs. Deep integration into IT operations, reliance on their AI analytics, makes it tough and costly for customers to rip them out.
Okay, strong platform, data advantage, brand, stickiness. How are they planning to grow from here, according to the sources?
The core strategy is land and expand. Start with endpoint, then sell more modules, identity, cloud, SIEM XDR into the same customer.
Cross-selling.
Exactly. And their net revenue retention proves it works. Sources say it's consistently over 125%. Existing customers spend significantly more each year.
That's a powerful growth engine.
It is. They're also targeting a much bigger market, the TAM. Sources estimated over $100 billion by expanding into cloud security, identity, AI-native SOC platforms.
So expanding the product footprint.
And expanding globally, too. Mentioned growth in Europe, APAC, addressing data residency needs, plus ongoing innovation, both R&D, especially in AI, and acquisitions like Humio, Preempt Bionic were listed.
So connecting the dots, the sources suggest this strategic foundation positions them well long-term, despite maybe some short-term bumps like the outage.
That's the picture painted. Strong competitive position, clear growth levers. That's the long-term story highlighted in the material.
Okay, so we've gone through the Q1 numbers, the outage impact, the guidance, the market reaction, and the strategy, all straight from these sources. Pulling it all together, what does this mean for someone looking at CrowdStrike from an investment perspective right now? based only on this material?
Well, the sources present a clear balance, really. On one side, you've got strong Q1 fundamentals, good revenue, EPS beat, record cash flow, solid ARR growth, plus those strategic advantages, a platform, the moat, the growth plan.
Positives.
The positives. But on the other side, the sources clearly flag the near-term challenges. That outage impact, both financially and reputationally, the slightly cautious Q2 revenue guide that spooked the market.
Right.
And the general pressures noted, like growth naturally slowing a bit as you get bigger, and the high valuation making the stock sensitive to any misses.
So it really sounds like the sources lay out this equation. Weigh the solid underlying business and long-term potential against these near-term risks and market sensitivity.
That's exactly the synthesis here. Based on this material, an investor needs to weigh CrowdStrike's competitive strength and expansion path against things like potential budget constraints out there, how smoothly they navigate the post-outage period, and whether that high valuation holds up if growth fluctuates.
We've covered a lot of ground financials, reactions, strategy, drawing directly from the sources you brought for this deep dive.
Yeah.
Hopefully this conversation gives you, our listener, a clearer, well-rounded view of the dynamics around CrowdStrike right now, all based on the info shared with us.
And it does raise an interesting question to think about, doesn't it? When you see strong fundamentals and a good long-term plan, how do you weigh that against near-term stumbles or cautious guidance, especially given such a sharp market reaction? It's that constant balancing act.
Something definitely worth mulling over. Thanks again for bringing these sources for the deep dive. Until next time.